We are following new data on the economy this morning. The latest jobs report from the Bureau of Labor Statistics shows 187,000 new jobs added last month. That's less than what was expected, but the unemployment rate dropped slightly to 3.5%.
So here to discuss, as per usual, is Javier David. He is in the studio with us, which is great to have you here. He's the managing editor for business and markets at Axios. He's also a CBS News contributor. So let's talk about the data. I mean, so it's a little bit less than expected, but it doesn't seem that bad.
Look, we've had 31 straight months of jobs gains, right? Unemployment rate, 3.5, dropped from 3.6, close to like the lowest since 1969. Average hourly earnings still going up, rose 0.4% for the month.
That's good.
People are earning more money,
Yeah.
like not really a lot to complain about. Really, if you know, there's a definitive cooling in the labor market, but it really does appear that the economy has created all the jobs that it needs for right now. If you're looking for a job, you can find one. If you're not employed, you're probably like, laid off tech workers. You've got a severance package. You've got a cushion. You've got flexibility. It allows you to be choosy about your next gig, whatever that might be. You really not a lot to complain about in these numbers at all.
Fitch, in your ratings.
Oh, that's a whole other discussion.
What about that?
We'll
I mean,
that
that was like the big headline of the week, Monday, Tuesday.
Right.
But it didn't really seem to rattle things.
So a couple of things that, the timing of it was curious, and some of the rationale that Fitch used was also curious, or at least questionable. They cited recession predictions, forecasts, whatever you want to call them, are being steadily scaled back by Wall Street. There's no recession in sight. The jobs market just literally tells us that. There might be something dramatic coming up that we don't know about, the notorious black swan that we like to call in markets.
What,
like
I'm learning a new term. What's
black
that?
Swans. It's one of those things that us financial nerds like to talk about. Like things that's coming that comes out of nowhere.
Okay.
COVID was a black swan, was a really big black swan. But that being
the
said,
whole lake of them, yeah.
But and it's actually a really big thing in Australia, but I digress. Anyway, Fitch's rationale was like they saw it in recession. They used some metrics that were kind of outdated.
Yeah.
You got a lot of pushback from Treasury Secretary Janet Yellen, ex-Treasury Secretary Larry Summers. A lot of the sort of mainstream Wall Street economists came out and said, this is kind of a curious decision. But the interesting thing is, after a day, everyone said, well, Fitch is fundamentally right. The story here is you have a U.S. where the political system is in disarray. The fiscal problems, the challenges are just getting worse. There's no plan.
And it's going to get worse next month when there's a potential shutdown.
We had a debt ceiling deal that really just sort of kicked the can out to 2025.
Yeah.
No fundamental sort of solving for what the problem actually is, which is unsustainable entitlements. A federal government that has drawn in record revenue. Like the government is pulling in a lot of money, but it keeps just spending and spending and spending, and it's sort of out of control.
Okay, let's bring the conversation back around to the Fed. Based on what we're getting are some pretty positive reports, and inflation is slowing. Yes, it's not 2%, but one could debate if 2% really has to be the goal.
Yeah.
And we know that every time the Fed shifts the interest rate, it takes a while for it to kick in.
Yes.
So what is the likelihood that the Fed will stay the course, considering some of the indicators that we're seeing here, and increase the interest rate again? It's
still too soon to say. Like a Goldman Sachs economist said this glorious phrase, we're in a period of normalization, but it's not nirvana. The markets are pricing in a soft landing. It's still very much an open question, but the Fed is closer than it has been throughout this entire campaign to being done. I mean, they've done a lot. The economy is clearly slowing. Inflation is starting to get under control, but wages are really telling the story. The fact that wages are still going up is a sign that demand is still in the economy. People really, the idea that they want to get out and they want to spend, and we're heading into back to the school season, and then that leads right into the holidays. People spend some more. The economy has real momentum, and momentum is a word that's been propping up a lot. It's not something that we associate with a recessionary economy, but it does suggest people are more willing or finding new ways to spend money. That's inflationary.
That is.
Javier David, thank you. Good to see you.
Absolutely.
Happy Friday.